Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name's Manpreet, and welcome to Through the Noise. Now, there continues to be quite a bit of optimism in financial markets, but we're also in the midst of a few very macro-heavy weeks in the US. Now, this, of course, as we know, started with the drama around the US jobs data release, but since then we've had a somewhat more benign CPI inflation number, but a much higher producer price inflation number. Now, this, of course, emphasizes the data dependency over the next few weeks, especially when added to the fact that US trade policy uncertainty is never far. And of course, we're set to hear Powell's comments at the annual Jackson Hole Symposium. So, what should investors make of all these events? To discuss that, I'm joined by Rajat Bhattacharya, who's a senior investment strategist at the CIO office. So, welcome, Rajat. Let's start with markets. So, global stocks climbed to another record high this week. What's driving this rally exactly?
Hi, Manpreet. I think a confluence of factors is fueling this rally, and it's possibly going to drive the next leg higher for risk assets. Now, these factors include expectations of Fed rate cuts resuming from September, improving in corporate earnings fueled by AI investments, and easing global trade tensions. Now, this is against the backdrop of a global easing of fiscal policy that we've been talking about for a while, notably in Europe and China, but recently in the US as well, with the passage of the Big Beautiful Bill. Now, a successful meeting between Trump and Putin to end the Ukraine war and a dovish speech from Fed Chair Powell at the Jackson Hole summit you referred to have the potential to drive equities higher, while disappointments here could lead to another consolidation. While we remain constructive on risk assets over 6 to 12 months, we really prefer the relatively inexpensive non-US markets, especially Asia ex Japan equities, given stretched US equity valuations.
So let's focus maybe for a moment going back to the Fed rate cut expectations that, as you mentioned, drove some of this week's equity rally. This week, of course, we had a mixed bag of inflation reports. So, in your mind, is the Fed still set to cut rates?
Indeed, the latest trigger for the risk asset rally was the US consumer inflation report for July, which eased concerns about a rise in goods inflation due to tariffs. Now, core consumer inflation accelerated to 0.3% month on month, mainly due to some volatile services sector components. In fact, the core goods inflation that we all have been looking at and watching rose by 0.2% month on month, unchanged from June. However, the subsequent producer price inflation report, as you mentioned in the introduction, showed companies are starting to pay higher prices for tariff affected goods, which are likely to be passed on to consumers. Now, we expect the impact on consumer prices to be temporary as slowing job market curbs wage growth, which is the biggest driver of structural inflation. Against the backdrop of this mixed US inflation reports, the focus is squarely going to be on the decidedly weak US job market report, which was published earlier. There is one more round of inflation and jobs data due before the Fed meets again on 16th and 17th September. Unless we see a spike in consumer inflation in August, the latest combination of a weak jobs report and modestly high consumer inflation argues for the Fed to resume rate cuts in September. Now, besides the 25 basis points of a September rate cut, money markets are pricing one more 25 basis points of rate cut by the year end. Fed Chair Powell has a chance to confirm or push back against those expectations at his Jackson Hole speech on 22nd August. Also, minutes from the Fed's last meeting, when two policymakers voted for rate cuts, and that was an unprecedented, almost not seen for 3 decades. That report on the Fed meeting minutes would also be scrutinized very closely.
Okay, so let's switch gear maybe to earnings. I mean, US earnings have been fairly solid and arguably have provided some fundamental support to the equity rally, but what about valuations? Is that something to be worried about?
That's correct. Now, besides Fed rate cut expectations, equities have been fueled by yet another strong US earnings season, powered by accelerating AI investments. Now, guidance from the AI related technology and communication services sectors remains strong, with the two sectors expected to deliver 19% and 13% earnings growth over the next 12 months. However, strong earnings notwithstanding, the MSCI US equity index is trading at a 22 times 12-month forward PE multiple, close to its all time high. A 12% earnings growth estimate for the next 12 months leaves little room for upward surprises, in my opinion. Now, investor positioning and sentiment indicators suggest there is still room for upside in equities before those indicators turn contrarian. In contrast, the MSCI Asia ex Japan and China equity indices are trading at relatively attractive 13.8 and 12.3 PE multiples, respectively. Now, given this, it would be prudent, in our view, to reduce any US overexposure and rotate to these inexpensive markets in Asia ex Japan. Besides attractive valuations, Asia ex Japan equities are benefiting from an easing trade tensions after major US allies, with the exception of India, reached preliminary trade agreements with Washington. Now, easing fiscal policies in China and Europe should help offset some of the negative impact of tariffs on those markets. The extension of the US China trade truce for 3 months and the relaxation of the US curbs on semiconductor exports to China are providing tailwinds to China stocks, especially in the technology sector.
So let's stay on that theme for a moment. I mean, Chinese equities, the outlook for those, I mean, do you expect the rally to continue?
Yes, actually, we do. Within Asia Japan, we are overweight on China equities with a focus on the Hang Seng Technology Index. And this is really on the back of the positive AI developments going on there and expected valuation re rating. The Q2 earnings season in China is in its early days, with only 10% of MSCI China companies having reported so far. The companies reporting thus far have delivered a 3.5% positive earnings surprise, according to Bloomberg reports. Now, earnings reports for the Hang Seng Technology Index are more advanced, with 32% of companies having reported thus far. These companies have delivered a 5.3% positive earnings surprise. Internet and technology companies are reporting strong growth in online and mobile entertainment, as well as demand for AI infrastructure. AI adoption, meanwhile, continues, whether to enhance mobile app features, support software development, or sharpen digital marketing. This is supporting a capex increase in China, albeit with a focus on spending efficiency. The relaxation of US chip exports rules would further support AI in China. We believe this would lead to a rise in the valuation of the Hang Seng Technology Index. Now, AI development would also support the broader China equity market, where valuation remains at an attractive discount to global equities. We expect policy stimulus, such as recent plans to support bank lending to consumers, to continue to stabilize China's growth and support earnings.
Thanks, Rajat. Maybe before we close, just a very quick one on the upcoming Trump-Putin meeting. I mean, I've been looking at videos in parallel of the Russian delegation landing in Alaska. I mean, how should investors position around this?
Yeah, all eyes are on that meeting actually, and that meeting is aimed at ending the Ukraine conflict. Although Trump has said that the do not raise expectations too high, but they have the potential to end the Ukraine conflict, and that would ease a major geopolitical risk, which is a key headwind for European assets, particularly. An agreement would likely bring down oil prices, significantly easing inflation concerns given the linkage between oil and long term inflation expectations, especially in the US. However, a deal is not guaranteed. We would hedge against any upside risk to oil prices, whether because of the talks fail or because of the tariffs, the impact of tariffs that we are still to feel in the economies through U.S. inflation protected government bonds.
All right. Well, thanks, Rajat. I think it's good to be able to squeeze that in before we run out of time. Thanks so much for joining us today and speaking to our listeners. If I can sum up top takeaways from this conversation, first is that we do believe that so far a September Fed rate cut is on track. But of course, incoming data and policy comments are still very important. Things can change between now and September. Second is that we do remain bullish on equities, but would particularly favor non-US equities, particularly China. And third, of course, we'd favor using inflation-protected bonds to hedge against oil and any other inflationary risk, particularly around the Trump-Putin summit. So with that, we'll bring today's conversation to an end. Thanks very much for joining us today, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.